Okay, good evening once again. So today you'll be starting with brokerage business. All right, so this is the main objective for this section. We'll discuss what brokerage business is about and know what brokerage business they do actually. When you are trading on the stock exchange, security holders cannot sell their securities to investors who are prepared to purchase such. And individuals and also investors cannot go to the stock exchange to transact business. They have to go through intermediary or what we call as agent or a broker. Let me use the word broker since you are doing brokerage business. Please, I hope you cannot hear me. I want to be sure before I proceed. Can you hear
Yes,
me?
sir, we can hear you.
All right, okay. All right, so when you look at brokerage business, they are very important because they serve as an intermediary between buyers and sellers of securities. Okay, it is similar to an agent. The normal agents, we know if someone is acting as an agent in an agency agreement, somebody who play an intermediary role or a betweener between two people. So when it comes to trading of securities, to have an intermediary by the name broker or brokerage business. We have so many type of brokerage firms. We have the investment bankers. All right, we have some banks that serve as investment bankers. We also have buyers and sellers of securities on behalf of customers. So far as they are acting on behalf of customers, it means they are acting as an intermediary. We also have principal making markets in securities. So these are the three main types of brokerage firm. And it also depends on the function that they perform. That will make them be classified under any of these three firms. As in investment bankers, as buyers and sellers, and also as principal making markets. Okay, now let's look at investment bankers. When you look at brokerage firms that act as investment bankers, we are saying that they sell the securities to the public without using the facilities of an exchange. All right. Investment bankers normally buy new issues. So that's what I think in our previous meeting, we spoke a little on this aspect, whereby they will buy the new securities or the new issues from the issuer at an agreed price, and they will resell it at a higher price to the general public. And I gave an example that maybe if MTN Ghana want to issue their shares, right? They cannot or they may not issue it directly to the general public, but they may pass through an investment bank. Maybe if you want to buy shares from MTN, you have to go to ADB Bank, or maybe you have to go to IB. All right, that is where maybe you can get the shares to buy. So they will buy it from MTN and they will resell it to the general public at a higher price other than the price they bought from MTN Ghana. Right. So they are also set to underwrite an issue in the capacity. So that is why they are also acting as intermediary because they buy and sell. Okay, there is another option too, whereby the sale of the shares may be in the form of best effort or agency agreement. Best effort means that um, they are selling it for MTN Ghana, but they are not really buying it and selling. That's another different. If they say they are using best effort, it means that they are not underwriting the issue, but they are using their best effort to sell it. It means that they are selling for MTN Ghana. So when that situation happens, it means that whatever proceeds or whatever remaining of the share will be returned back to MTN because they are not doing buying and selling. They are using a best effort agreement or agency agreement. So yeah, as I said, any unsold securities will be returned to the issuer. And mostly this effort activity will normally be used in the sale of new and small companies. So companies that are now coming into the system, they are not really known in the system, so people find it difficult to invest in them. With these new firms, if you go and buy their shares to resell, you may not be able to sell it all because people may not have the trust in it because yeah, they are now coming into the market with assurance that they can even survive in the next 3 years. If I go and buy shares and they don't survive, it means that my money is going down the drain. So when it happens, intermediaries will not be willing to buy and sell for these firms, but they'll use their best effort agreement because of the risks involved. We also have brokerage firm who are buyers and sellers of securities on behalf of customers. Now we've stopped on investment firms or investment bankers as one of the firms. We also have buyers and sellers of securities on behalf of customers. In this function, the most brokerage firms are known by the investing public, and based on how they come into contact with the broker. So here they act as an agent. So a broker trading enlisted is acting as an agent on behalf of a client. So this is more of the individual acting as a broker instead of a bank. All right. So we've looked at investment bankers as a type of brokerage firm. We also have the individual who act as brokers. All right. So this is more of an agent. Okay. You work through me. I look for a buyer for you for your securities, and you do the exchange. And in return, I also get my compensation, which is in the form of a commission. All right, locating one person is what you see when you go to Accra and those places. If you want to rent a house, there are some places when you go there, they will tell you they've given it to an agent. So if you want to, you cannot go directly to the landlord unless you pass through the agent. So that is a layman's example because the agent will have a commission on whatever clients he or she brings to the landlord. All right, so that is similar to a broker. They act as an agent on behalf of a client, and they receive compensation in the form of commission for their services performed. And one key point that should be noted is that a brokerage firm must exercise care and also demonstrate a reasonable amount of skills in filing customers' orders, because you have to get the specification, you have to get the exact thing that your customer is asking for. You cannot act on your own knowledge. Everything must be based on an order, based on an instruction from your client. Okay, so we are saying that the brokerage firm may also be liable for any losses that result from its mistake, because you are acting as an agent and you should base on available information, not just based on intuition or notion. Everything should be based on instructions. You have to have the skills and you have to be ready to also follow instructions so that you don't trade on your own, but you act fast in possible time so that you don't make any mistake. That is what we are trying to explain here. We also say that a brokerage firm cannot act as a dealer and a broker in the same transaction because there will be a conflict of interest. So you cannot act as a broker and also a dealer in the same transaction. Right. We have another function or another type, which is the principal making market in securities. So the broker function as a principal and makes market in security. They can make their own markets. So the broker's main principal activity is to bring sellers and buyers together. That is the main purpose or function of a broker. But a brokerage firm is also a middleman. And as a true intermediary, brokers bring sellers and buyers together and they create a market. And this is mostly done through the over-the-counter, but can also take place in listed securities. So that is where the focus of the principal making market in securities happens, in listed securities. So if the securities to be traded are not listed on the exchange, but traded in over-the-counter markets, the broker might own the shares himself. So if it's not on the exchange and it's in a OTC, that is over the counter, the broker might own the shares himself, but on the exchange, the broker cannot act as a broker and a dealer. It will lead to a conflict of interest. It's like a landlord also acting as an agent, which is not supposed to be. Okay, so I think this is the same. All right, so now let's look at some of the functions of a brokerage firm. Now we have an idea what brokerage firm is about. What are some of the functions of a brokerage firm? So we are saying that they provide customers with information to help them purchase suitable securities. Okay, if you know the functions of an agent, at least you know in an exam set, maybe pressure, you don't remember, at least you can have a linkage between these two. At least it will help you. So we are saying that they provide information for customers to help them purchase suitable securities. They also inform their customers about individual companies and industry. They also believe that they cannot serve their clients adequately unless they provide them with information. I think these points are all looking at provision of an information. And another point is that they provide indirect investment management services. Indirect means that the services is not direct, because they are the one connecting, but they can give you an investment advice. All right. So one way or the other, they are providing indirect investment management services. Okay, so this one, they are just an explanation to the points we've explained. All right. So point one, talk about the provision of an information. So we are saying that most brokerage firms continue to provide research reports on individual companies and industry. All right. And as an investment analyst, these are some of the things you should know. You should always be researching into companies to know if the company can sustain into the foreseeable future. All right. You have to look at um, the going concern of the firm. Can the firm be sustained within the next 5 years? The industry in which the firm operates, is it a moving industry? Are there any chaos in the market that can affect the performance of its shares? So all these are some of the things that we have to look at it. Right. You see, there are a lot of chaos happening around the globe. Okay, there are Russia-Ukraine war is there. Other countries too are still, this geopolitical conflict and all that. Some of these affect some industries in the world. So if you are trading in such industries, you need to be satisfied with enough information about the foreseeable performance of the firm. Okay, so let's use Russia-Ukraine war. What do you think are some of the industries that such geopolitical conflict can affect? Which industry do you think will be affected the most? Not just the most, just mention some of the industries as an investment analyst. And a customer is asking you this. What do you think would be the best? What are which what are some of the industries that may be affected by this geopolitical conflict? Anyone can speak. Are you there?
Yes, sir.
Okay, so anyone can help. What are some of the industries that will be affected by geopolitical conflicts? Example is the Russia-Ukraine war or the Gaza-Israel issue. Any one of them you can use. Anything you can think of. What do you think? Okay, you can use COVID-19. At least you are in Ghana, so let's talk about Ghana. COVID-19. COVID-19, you are in Ghana. Let's talk about COVID-19, please. Or I should start mentioning names.
Hello, sir.
Yeah, Andres.
Good evening, sir.
Good evening, Andres.
Okay, sir. So, talking about the COVID-19, I think that during the era of COVID-19, the transportation industry was affected.
Okay.
For about, I think, 3 weeks, we were supposed not to go anywhere. So most transport industries stopped operating. It was only emergency services that were supposed to operate. So I think that the transport industry was duly and mostly affected.
Oh, okay, that's true. I think that's true. Perfect. All right, thank you. All right, so let's move on. That's true. Okay, so all these are just explanations to the point that we let's do. Now let's look at factors to consider in selecting a brokerage firm. What are some of the factors you must consider? And as an investor, you want to select a broker or a brokerage firm. What are some of the factors you should consider? So the first step is that you must select, or first you must establish a satisfactory relationship with the broker is to choose a firm that is suitable for your investment needs. So you must first of all select a broker or choose a firm that is suitable for your investment needs. You must select a firm that is suitable for your investment needs. This is a very crucial point. All right, you have to choose a point or a firm or a broker that is suitable for your investment needs. Who can help us explain this? Why do you think it's a crucial or it's a point that must be satisfied before you can move on to the next? All right, because some firms focus, every firm has their own focus. So as an investor, you also have to have a focus. And based on your focus, you should know which investment firm or which brokerage firm matches your investment needs. As simple as that. Okay, this is just an explanation. So good. Let me add a few things. So if the investor is new in the investment business, it is important he select a broker who will be willing to spend time to educate him in the fundamentals of investment. That is another thing. So you should select um, a brokerage firm that matches your investment needs. By so doing, you want to select a broker who will be willing to spend time with you, especially if you are new on the industry or in the market. You need to get a brokerage firm or a broker who will be willing to spend time to educate you in all the fundamentals you should know about the investment. Second point, the brokerage firm selected must be well known and long established institution. Okay, the brokerage firm selected must be well known and it has to be a long standing relationship or it must be established or it has to be a long established institution. So that is the brokerage firm must have an unquestionable credit rating. If you have a bad track record, I don't think someone will be willing to select you. That is why there are some businesses, if you don't take care, just an information can ruin or wipe away all your profit. Just a little information that goes out there can, because information has power. Information has power when it comes to these security markets. Information, just an information can cause a lot of chaos on the market. Let's use the CD and the dollar fluctuation as an example. Okay, it will get to a point, maybe a politician or a well-known person will just come out that maybe the dollar is not performing, something. They will just come out with something and it will cause panic in the market. When this happens, it translates into the performance or the strength of the CD dollar translation or conversion. So information is very powerful when it comes to the security market. So the brokerage business must have an unquestionable credit rating and it must be of sufficient size and experience to provide the necessary investment service. That's the second point. The third point, in selecting a brokerage firm, you should try to judge the type of clientele that is being sought by the firm in relation to the type of investor he is. Okay, clientele means that um, each firm or each brokerage firm will have their specific clients that they want to attract. Okay, there are some mechanic shops when you go there, they specialize in only Mercedes cars. Let me say just Mercedes Benz or Toyota. That is the only brand that they service on. Okay, so if your car is um please someone should mention any car. This one there you have to mention some. We don't like talking, right?
RAV4.
Good, RAV4. So if your car is RAV4, you cannot take it there for servicing because that is not the type of client they want to attract. Please, I hope with this example you understand the clientele that is being sought by firm.
Yes, sir.
Yeah. So based on some of them will want to deal with people, multinational firms. That is the type of clientele that they want to attract. They want multinational or billionaire like firms that has higher, money. So if someone like me that my money is up to just 5 CDs, I don't dare to even go there because I cannot even pay for their consultation. Please, I hope you get it. So we have to know um the the type of clientele that is being sought by the firm. Okay. Point four. Selecting a brokerage firm that provides research facilities and adequate information. That is, and I think this is self-explanatory. Yeah, so we don't need to explain it again. Point five. Many brokerage firms combine their regular brokerage business with a volume of activities such as underwriting of new security. So this is another point you should consider. There are some brokerage business aside their regular business, they also provide other services to their clients. So if you be interested in such, at least you should look for a firm that is willing to perform other services other than their underlying service or their regular brokerage business. All right. Because let's you look at others. So when you get to others, I think you understand this one, the point five very well. Point six. Once the individual has selected a reliable firm, a qualified broker must be chosen. So now it means that point six means that now you have to select the brokerage firm because you've satisfied yourself with point one to five. It means that you have to select a qualified broker, which means a registered person or a registered representative. Okay, they are just explaining more on the point six. Others, others on the security. Others when it comes to food, because all of you have one way or the other order for food before, true or false. Even the married ones, you've ordered for food before at the workplace. Or someone is here who have never ordered for food before.
Mhm.
Andres, Andres,
Yes, sir.
did you
Yes,
order
sir,
for
boss, sir.
today?
Uh, Today, in fact, I went to buy it myself.
Oh, okay. All right. So please, I hope you understand. I just want to draw your attention to what we are going to talk about because order may be similar to the one that you already know. But that one is not the same as what we are going to look at today. But if you know what an order is, at least explaining this one should be easy. All right, so let's start. In the security market, we have various type of orders. So an investor, any of you can be an investor, may give an order to his client or his broker. Let's use the broker rather instead of client. I'm the investor, I have a broker or a brokerage firm that I've selected to act as an intermediary for me. So that anytime I want to buy something on the security market, the broker or the brokerage firm will do it on my behalf. Okay. So maybe I can give an order to a broker to execute in buying or selling. It's not always about buying, it's buying and selling of securities. Okay, so for the broker to satisfy the client, for the broker to be able to satisfy the client, these orders must be followed strictly. And the underlying way is strictly. You see, we spoke about some of the functions of the brokerage firm, and we also talk about the fact that if the brokerage firm or the broker incur any losses, he will be liable for it because you cannot act on intuition. Whatever you have to act is based on instruction. As simple as that. So these are some of the orders that an investor may give to a broker to execute on his behalf. Please, I hope now the floor has been set. We can move on.
Yes, sir.
Can we move on?
Yes, please.
All right. So we have market order, we have limit order, we have time limit order, stop loss orders, we have stop limit orders, and also odd limit orders. They are not difficult. You should be able to explain all of them because in an exams, you may, in quotes, you may be asked to explain some of these. Maybe explain the following or differentiate between the following: time limit and stop loss orders, market order and stop limit orders. Explain the difference between the following. Some marks will be allotted for that. So, yeah. So you should be able to explain them. Now let's start with market order. Market order. So market orders are executed as fast as possible and at the prevailing market price on the exchange. So it's simply an order which is to be executed immediately at the current market price. Let me highlight that part for you. So here is simply an order. Please, can you see?
Yes, sir.
That's the keyword I want to. It's simply an order to buy and sell, which is to be or which are to be executed immediately at the current market price. So any order which is to be executed at the immediately at the current market price is what we call as market orders. All right. So what is some of the advantage of a market order? The advantage of a market order is the speed at which it is executed. And the problem with market order is that the investor may pay different prices for the same order. You may pay different prices for the same order because you are executing the order at the current prevailing market price, and you know price changes within time. So you may end up paying different prices for the same order. So they give an example. If 500 cedis and 600 cedis represent commitment up to 1,000 shares, an investment who wishes to buy more may have to pay a higher price for the rest of the order. You may have to pay more for the rest of the order. Limit orders. Limit. This one, English play role. Limit. Okay, in limit orders, investors will specify prices at which they are willing to buy or sell. It means that market order means they will not specify the price, but any price that is available, they are willing to buy or sell. I hope you understand. You see, as you are explaining the subsequent, you understand the previous more. Limit means that investors will specify the price at which they are willing to buy or sell the security. Unlike a market order, there is no specification. We buy or sell based on the prevailing market price. Any price that is available, that is when we buy or sell. But when it comes to limit orders, investors will specify the price at which they are willing to buy or sell. So, for example, an investor may instruct his broker to buy ABC Limited shares if and only if the share price falls below 570 Ghana cedi. So they will instruct their broker to buy the shares of ABC Limited if the price of the share or the share price falls below 570 cedis. That is a limit order. The order has been placed, but you can only execute when the limit has been reached. So if you go and the price is 580, you don't execute until the price falls below 570. That is when you can execute. We also have limit order to maybe to sell. So to sell means that you only order your broker to sell when the price rises above, right? Definitely nobody will sell when it goes below. So when it goes above the specified limit. So if I'm buying, okay, if it falls below 570 buy, I'm selling. Okay. If it goes above 570, then you sell it. So maybe you are dealing in dollars, all right? Now the dollar is still on the rise again. But sometimes it rises, it reaches its peak and it starts falling again. So okay, you've instructed, you've given the order, limit order to your broker that anytime, or your investment banker, or maybe you have a dollar account, let's use that way. So anytime maybe the dollar reaches 15 cedis, if it goes above 15 cedis, I want you to sell my dollars for me for cedis, something like that. And when the dollar goes below 10 cedis, then you buy some dollars for me. Please, I hope this one is clear. So that is the limit order. Because if you understand one, you understand the next one. Letitia, I say your line is breaking. I'm not sure it's maybe it might be from your side because today my internet is very good. Or all of you are having the same issue.
No, sir.
No, sir.
Yeah, Letitia, so check your internet connection. Do you have
Yes,
it
sir.
strong?
Doctor, sir.
Yes, sir.
Right. I want to ask something small.
Right.
So I want to. So in the limit order, it means that if the price doesn't fall to the level that the investor is looking for, it means that you don't sell.
You don't execute.
You
Let's
don't
use the word.
execute at all.
It can be buy or sell. You don't execute. Call.
No.
That is the
All right.
limit order.
Okay.
You understand better when you get to the next type of order. But there will be an order which you have time limits. I hope you get it. Right. So
Yes, sir.
let's move to the next. Any other question before we continue? All right. Okay, so this is the advantage of the limit order. The main advantage of limit orders is that the investor has advanced knowledge of the potential transaction. You have an ahead information of the potential transaction. So it set the boundaries of risks the investor is willing to assume. The major disadvantage is what my brother just asked. The disadvantage is that a limit order may never be executed because limit orders are normally away from the market. Limit orders are mostly away from the market and they might never be executed because the price in which you are willing to execute might never reach there. Imagine I buy dollars today and I tell my broker to sell it when the dollar reaches 20 cedis. Can you imagine when I'm going to sell the dollar? Let's be rational. When do you think I will sell the dollar? Maybe Christmas. Even Christmas, there's no way the dollar, because Christmas people import a lot of Christmas items. And August be here. But even with that, the dollar will never rise to 20 cedis. Well, what do you think? Let's elaborate. limit orders may never be executed based on some of this because the price may be away from the market. Away from the market means that it's away from the prevailing market or the fair value that we all know. Because some people, especially farmers, 'cause I know farmers who harvest their maize and they will stock them for years with the hope that the price of maize will rise so that they can sell their process. You see, one way or the other, we are all practicing this type of orders, but you don't really know the technicalities or the exact thing we are doing, but we are practicing one way or the other some of these type of orders. Please, I hope you understand.
Yes,
Yes,
sir.
sir.
All right. Okay, so time limit orders. So orders can also be limited by time. So at the time the investor places an order, the period for which the order is to remain in force will be specified. So we have different types of time orders. We have day orders. Day means that the order will expire at the end of the or at the close of the day. Just at the close of the day. Okay. We have open or good till cancelled. With the day orders, you see, day orders, you may be familiar with the day orders, especially these businesses like the, you see, let's use Black Friday. There are some shopping sites, they do these day orders. They open their shop maybe from 5, maybe from 8 a.m. to 5 p.m. Anything you buy will attract a discount of maybe 40%. Have you experienced those things? When it gets into Christmas, those things mostly happen. It means that the orders still remain in force. When the day closes, it means that the order is no more in section. So the order to sell some good below the normal price will be specified by time. We also have open or good to cancel. Good to cancel means that the orders will remain in force until it's either one executed or is cancelled by the customer. So maybe if you have set a time limit orders, meaning that you want to sell something at 10 cities, maybe by the close of 2 days. So if 2 days you're able to sell at 10 city, you have executed. If at the end of the 2 days you are not able to sell, it means you cancel the order. As simple as that. So it will be good till cancelled. So it normally remains in force up to 6 months, even if time is not specified. So if there is no time limit specification, the maximum time with which a time limit orders will be in place is 6 months, unless cancelled by the investor. So if the investor does not cancel, automatically after 6 months, the order has to be terminated automatically. Okay. As a matter of convenience to a customer, a broker may accept an order for a week, month, or through a specified period. Please, I hope you're okay with the time limit orders. Now let's move to stop loss orders. Stop loss orders. So this is similar to limit orders because you are stopping loss. It means you are limiting loss, in a way. So stop loss orders is similar to limit orders because the trade is not to be executed unless the stock price hits a price limit. You don't have to execute until it hits a price limit. So stop loss order to sell will be executed if the price of the stock falls below a stipulated level. So stop loss order to sell will be executed if the price of the stock falls below a stipulated level. Okay, so let me explain this. Ghana, we take risk, all right? So this is more of maybe I want to sell my car, or let me use something that has a price fluctuation. Let me use the dollar. Okay, dollar will be best. Okay, the dollar is now around 12 cedis. So let's say you have an order from your client to sell your dollar. Okay. They didn't specify the amount to which you are to sell it, but they let you know that if you cannot sell it below this amount, so anytime the dollar is falling below or when it hits 11 cedis, then fast you have to execute it because you don't want to incur more losses. So you are just trying to stop loss. Okay, so you don't want it to fall cry before maybe you're expecting a rise in it, but it's not rising, but it's falling. It keeps on falling. So you set a stop loss limit to it or a stop loss to it that anytime it hits 11 TDs, as soon as possible, we have to execute before we run into major losses. That is what the stop loss order to sell is about. So similarly, a stop loss order specifies that a stop is to be bought when the price rises above a limit. Okay, so order to buy it should be executed when the price rises above a certain limit. Okay, maybe the price is 10 cedi now. You're expecting the price to fall, but all of a sudden the price is rising. So when it gets to a point, you say no. At this point, if you don't buy, you may not be able to buy tomorrow. That one, car, even land will be a perfect example. Okay, someone will give you a land maybe 50,000 for a plot. Then maybe tomorrow, 3 days time, the person is now saying that, now the value has people are coming on it. So if you want to buy now, I'll give it to you at 55,000. Even though you are not really ready to buy, but because the price keeps on rising, you set a limit that no, if it's able to rise to maybe 60,000, then let me buy it before it escalates. All right. That is how some people they use that's how they do their pricing. Okay, so as the name suggests, the order lets the stock be sold to stop further losses. That is the main key point of the stop loss. You sell with the anticipation of limiting or stopping further losses from accumulating. Okay, we also have stop limit orders. Stop limit orders is also a device to overcome some of the uncertainty of the stop loss order. Because with the stop loss order, they didn't specify any price to only when the price falls to a certain limit, that's where you are supposed to execute. What if the price is rising? Is there any limit to it? So in a typical stop loss order, so this one they are using a stop loss order first. In a typical stop loss order, the investor does not know what the execution price will be after the order becomes a market order. But to overcome this problem, an investor may go further to specify the limit price. So maybe an investor may fix a minimum price at which he is willing to sell, but go further and specify a price below which trading cannot be executed. So the stop limit order, maybe you are willing to sell your car. Maybe you are selling your car at 50 cedis. Ghana, we always overprice because they'll ask for a reduction. Okay, so that genuinely you want to sell the car at 40 cedis, but you are selling in Ghana, so you have to quote 50 cedis. So that when they ask for reduction, you bargain down to the 40, then you stop. This means that you have fixed a minimum price at which you are willing to sell. That is the 40, even though you quoted 50. So the stop limit orders means that anytime the price goes further or it goes below the minimum price, the order should not be executed. So if somebody comes and Ghana prepare because I'll give you 25 cedis, 25,000. No, you cannot accept because the minimum price that has been fixed is 40 cedis. Simple like that. That is the stop limit order. So when the price willing to sell, go further and verify. Okay. So, for example, an investor may instruct his broker to sell his stock if the price falls below 50. So, if you've instructed your broker to sell your stock if the price falls below 50, but enter a stop limit to sell at 48. To sell at 48. It means that nothing below 48 will be acceptable to the investor. So we are saying that if the price falls below 50, you should sell it. But if the 50, it goes below 48, don't sell it. So it means that between 50 and 48, that is when you are willing to sell. If it goes below that, don't sell it again. So the only danger with the stop limit order is that the order may never be executed if the market price keeps moving downwards. If the price keeps on falling, you may never be able to execute such an order. Because if you do, it may result in huge losses. Odd lot orders. So orders in an exchange are normally done in establishing it. So maybe 100 units. That's are mostly how the orders are. Maybe some of the shares they are sold in hundreds, like that. But it will be possible for orders to be made which are less than 100. This is known as odd lot. So if an investor wants to purchase 150 shares on an exchange, this will be a combination of one lot or a round lot and an odd lot. So they are just basically explained. I think odd lots is self-explanatory. You can explain. If they are in units of 100, odd lot means that anything below 100 is an odd lot. Okay. So odd lot permits an investor who has limited financial resources to purchase a modest number of shares in many companies in order to obtain diversification. Maybe you cannot purchase all the 100 in one unit. You want to have 50 bond, 30 shares, and maybe 20 other in order to build a portfolio of 100. But you cannot buy only 100, right? So the odd lots will help you to build and obtain diversification. Disadvantage is that there will be price differences and there will be minimum commission charge because of the price differences. Because you are not buying from one place, the price variation may not or may reduce the commission that may be received. All right. So this is all about brokerage or brokers. That is what most of the things about brokerage have been treated. Any questions so far? We are moving to the next section. Can we move on now?
Yes, sir.
All right. Okay. Okay, so let me. Okay, so yeah, getting there. So now let's look at investment. The higher the returns. So today we are going to look at investment. And we are continuing actually. We are not looking at what we've already started. We are looking at investment, return, and risk. We already explained what an investment is in our first meeting. We explained what an investment is all about. All right. So by this section too, we also look at what an investment means, the meaning of return. We also look at risk and return. And when we are looking at risks, we have systematic risks and unsystematic risks. It's the same as diversifiable and undiversifiable risk. We also look at some computation, how to calculate expected return and also risk, and any historical recent return on asset class. So we are going to look at all this. So as we defined the other time, return is the gain or loss that an investor gets from undertaking an investment. So anything you get in return. So you see, even me, I use the word in return in defining return. It's not supposed to be so. Okay, so any gain or loss that an investor gets from undertaking an investment is what we call returns. Okay, return. So it is the change in value of an investment plus any additional cash flow that is attributed. Okay, so it's not only the interest you are getting, but any change or additional cash flow that may come from the investment will also be treated as a return on the investment. All right. So let's look at when you buy shares or bonds, there are two main form of returns that you get. So one, you get interest payment or dividend. So when you buy shares, okay, when you buy shares in a firm, first of all, we have two forms of returns that you get from buying shares. One, you get the interest payment. But when it comes to shares, we call it dividend. You get dividend, one. And two, you also have capital appreciation. That is capital gain or capital loss. That is another form of return. Return is not always positive. Remember, it can be negative too. That is why we have capital gain or capital loss. Capital gain or loss means that the value of your shares, when the value of your shares increases, it means you are getting capital gain alongside the dividend that you'll be receiving at a regular interval. That is the two main form of gain you are going to get from when you buy shares. So let's take some example here. Suppose you bought shares in Bank at 20 pesos per share in 2018. That's the price of the share. By the end of the year, the share price of the stock had appreciated to 31 pesos. It means that the value has appreciated to 31 pesos. What do you think is happening? It means there has been a capital gain of 0.31 minus 0.20 because the price of the share has increased to 31, even though you bought at 20 pesos. So there has been a capital gain of 11 pesos. Please, do you agree with me?
Yes, sir.
Yes, sir.
Yes,
Right.
sir.
Yes, sir.
Okay. So here you say that the return on the investment will be 11 pesos. And we refer to as the capital gain, as I just said. So let's assume that if Bank also paid a dividend of 30 pesos per share, it means that the total return on the shares is going to be 41 pesos. That is the return, that is the dividend plus the capital gain. These are the two returns you are going to get. The dividend of 30 pesos and the capital gain of 11 pesos is going to be a summation of 41 pesos. That is the total return you are going to get. But returns they are computed in percentage wise. Okay. So in percentage wise, the percentage of return equals the capital gain plus the dividend over the share price. And the share price, we are talking about the initial share price. The share price at year zero. I mean, the year you bought the shares. That is the share price. So the capital gain plus the dividend over the initial share price times 100% will give you the percentage return. Okay, so with this one, it's going to be 0.11 plus 0.30 over the initial price, which was, I didn't check, I have to go back and see. The initial price was 20, 0.20, 20 pesos times 100. Okay, oh, okay, they've even done it here. Okay, so the percentage return is 0. And please, I would advise that you get calculators. If you don't have some, please get some. any computation we do, try and do it yourself. Okay, I might make a mistake somewhere with the addition, so you have to do it yourself and be sure. Because when you go to an exams and I bring the same question there and you repeat the same mistake, I'll mark you wrong. And you don't come and tell me I gave you that, so you're also giving me that. No. So always try and confirm any figure you see in the slide before you get satisfied. It can be, please, I hope this is not a big deal. Right.
No, sir.
Yes, sir.
Okay. All right. So example 2. Assume that a company's share price rises from 35 pesos to 75 pesos over a 1-year period, and the share price has also paid, and the share has also paid a 20 pesos as dividend per share. What is the percentage return of the share? I know it's not difficult because we are saying that the percentage return equals the dividend or interest plus the capital gain or loss over the initial share price times 100. So here, the dividend is 20 pesos and the capital gain is 75 minus 35, which is going to be 40 pesos, all over the initial share price, which is 35 pesos times 100. And we are getting 17.4% as the return on your investment. Is it difficult to calculate? If you don't understand, let me know, please, before we move on.
No, sir.
All right, thank you. Good. Now let's look at tax consideration. There are some investments product that comes with tax. It means I have to pay tax on your returns. Okay. So even we have some types of business, sole proprietorship, partnership, and company. You've done business law, so you may be familiar with some of these. Okay. Company, when it comes to company, the company may pay tax on profits. And when they are sharing the profit among the shareholders too, shareholders who will also be paying dividend on they will be paying tax on the dividend. It means that there will be double taxation there. The same profit they are tearing so many tax. But sole proprietorship, we assume that it's a tax free because you don't pay tax on the personal income. Okay. Are you doing taxation?
Yeah, we are done with it.
We are done with it.
Oh, then I think you understand whatever I'm saying. So why am I even worrying myself? Then let's move on. So should we skip this side or we should continue?
Sir, please continue.
Let's let's continue.
Oh, okay, all right. Okay, so dividend and capital gain are tax. Okay, they are tax deductible. Now let me use your terms. You are the ones doing taxation, so I know now they are taxable, right? Okay, the tax laws is supposed to be tax deductible. Okay, so it means that in some countries only dividend or capital gains are taxed, where in some countries both dividend and capital gains are supposed to be taxed. All right, so when there are tax components, you have to adjust the formula and introduce the tax elements. So when there is a tax consideration, the formula. So the first formula, see when you look at the bracket, it affects only the capital gain. So it means that we are assuming that here the tax component or the tax affects only the capital gain and not the dividend. And the other formula too, you have the tax at the dividend side. So we are also presuming that through whatever we are doing, we are trying to say that the tax can affect either the capital gain or the dividend or both, depending on the nature of the question. So if the nature of the question, it looks like the tax will affect both capital gain and dividend, it means that we have to use the third bracket. So it's capital gain plus dividend all into brackets multiplied by 1 minus t. It means that the 1 minus t is multiplying the whole thing in the bracket. It means that it affects both capital gain and dividend. But when you look at the one up here, it affects only dividend, and the first one also affects only capital gain. So T is tax, that one you know. So the tax component is 1 minus T multiplied by the component. And I'm sure they will give you the tax percentage in the question, so you don't need to worry. So let's use this third example. Using the example 2 above, assuming capital gains are taxed. I hope you can see it. Assuming capital gains are taxed. So here we are assuming that it's only capital gain that is taxed. So the tax element will affect only the capital gain. So we are using the first formula. Capital gain into brackets 1 minus T plus dividend over initial share price times 100. So the capital gain was 40 because it was 75 minus 35. That is why we got 40. And the tax is 20%. So 1 minus 0.20. It wasn't supposed to be Ghana cedi because it's tax. So the cedi sign was not supposed to be there, This is tax. Okay, so 1 minus 0.20 plus the 20%, which is the dividend, over the initial share price of 35 times 100. And we are getting 14.86. All right. So I hope this one too is not difficult. We are just introducing tax elements.
Tax.
Come again.
No, I was repeating what you said.
Oh, okay. All right. Okay. Thank you. So here, so now with this example, we are assuming that the dividend and capital gains are both taxed. So we have to add the two and multiply by the tax proportion of. As simple as that. All right. Now we are going to look at the real rate of return. What you looked at is the nominal rate of return. So here we are going to look at the real rate of return. So the nominal rate measures how much more money you have at the end of the year if you invest today. That is what we just looked at. But it does not tell us the quantum of goods and services you can buy with it. Okay, but because the real rate of return consider inflation, Ghana inflation. So with the nominal return, we just look at how much more you are going to get today when you invest. But the real rate of return inculcates inflation as an element. So we are going to convert from nominal to real rate of return by using the following. So as simple, this is the formula. Real rate of return equals 1 plus nominal rate of return over 1 plus inflation minus 1. Okay, so just have this formula somewhere in case you need it. You will come back and take it. Real rate of return equals 1 plus nominal rate of return over 1 plus inflation or minus 1. So let me just walk through this example. Assume inflation was 11%. Assume inflation. So you see, when you see a question, you can easily see which formula you are using because of the element or the element they are giving to you in the question will help you to know which formula you are using. And it will not be tricky. With that one, I can promise on that. A little tricky, sorry. Assume inflation was 11%.
A little tricky.
Yes. Assume inflation was 11% in the year under consideration. So using the above example, where both dividend, we are just using the purest example, but here they are giving you an inflation of 11%. And the question is to calculate for the real rate of return. So for you to calculate the real rate of return, first of all, you have to calculate your nominal rate of return. And now you know how to calculate your nominal rate of return. That is the capital gain plus dividend if any tax element over initial share price times 100. Whatever you get is the nominal rate of return. Then you can now calculate for your real rate of return, which is the 1. Is it 1 plus? Yeah, 1 plus the nominal rate of return over 1 plus the inflation or minus 1. As simple as that. Then you are good to go. Okay, this is similar to this. So good. Here the solution is not here, so you discuss it. So I'm reading it so that someone will walk us through how to solve it. Suppose you buy a bond for 2020 with a 15-year maturity, paying an annual coupon of 80, 80 Ghana cedi. A year later, interest rates have dropped and the bond price has increased to 2050. What are your nominal rates and real rate of return? Assume inflation rate is 4% and capital gain tax is 25%. How do you find the nominal rate of return? Someone should walk us through, please. How do we get the nominal rate of return? You've just done it, so how do you calculate the nominal rate of return? I'm waiting. Oh,
So,
please, that is, yeah. Ashiba. Please, I hope I mentioned your name right.
yes, sir.
Okay.
So I think 150, 105, that's
1,050.
1,050 minus 1,020, which will give us 30.
Good. So the 30 is what?
Is a capital gain
Good. Continue.
plus our dividend, which is 80.
80, that's true.
Yeah. Then the
And
percentage, the
the
tax
tax.
percentage is 25%, and
So it's
it's that one is affecting only the capital gain.
good, because they were specific capital gain tax.
Yeah,
That's true.
yeah.
So I
Divided
think
by
that's
the
initial, which
divided
is
by the which is 1020
1,020.
times 100.
Good.
So when you
That's
get
good.
that one, then you use it.
Yeah, you get your nominal rate, then you can use it to calculate for your real rate of return.
Yes, sir.
I hope it wasn't too difficult.
No.
All right.
If you can get it like this, there.
That's how you get.
If it will not be the other way around.
Oh, even if it's the other way around, I'm sure you have an idea by the end of our meeting. So let's proceed. Okay, so this is the solution. Azali House, you explain it. You had 30 and the tax was multiplied. Yeah, so that is it. Please, I hope you can all do it. Those who are observing us and they are not talking, I hope you can do it. Abena Pepra. Please,
Sir,
sorry, okay. I
please,
don't know your names, so I'm just using the names
sir,
I can see. So if you have a
the
special title, don't mention it. Don't
sir,
be offended. Yeah.
the solution, the city sign is still there. The tax,
The tax,
yes.
yes, is supposed to be removed because tax is not in cities, it's in percentage. So this one has to be removed. So when you are solving, you don't have to bring the city sign, please. So I'm on a 0.25 because it's percentage. I'm on ST. Yeah, 25% or 0.25, sure. Okay, so but I've told you to confirm the figures when you are doing your personal studies. Make sure you use your calculator. If you are not getting the answer, whatever you get, so far as you can confirm from a colleague is the right thing. Good. Now we are going to look at expected return. So Afiba, now we are looking at the other way around. If you know, you know. Now let's look at the expected return. Okay, expected return is the weighted average of the outcome anticipated when you invest. Okay, so the general formula for estimating expected return is given us. Now the sigma, the probability times the returns, which is R. where P is the probability of possible outcomes and R is the possible outcomes. And you know what you mean by weighted average. So the formula above is what we refer to as the probability weighted average. This formula is what we call the probability weighted average. So we are going to elaborate on it. The probabilities may be based on past experience, maybe industry ratios and trends, interview with company executives, and also sophisticated simulation techniques are what they use to derive the probabilities. Right. So expected return, expected. Okay, so expected means that it's based on probability, expectation, it's based on probable event that is going to happen. So let's use this example to explain. So assume we are examining an investment. We are examining an investment with the possible outcomes and probability below. So the outcomes for the investment are 450 Ghana cedi, 650 Ghana cedi, and 850 Ghana cedi. And the expected returns in terms of, and the probabilities or the outcomes are 0.2, 0.6, and 0.2. You know, probability, definitely they will sum up to 100% or 1. So that's why I have 0.2, 0.6, and 0.2. And the question will tell you to calculate the expected return. So expected return means that did you do business finance?
Yes, sir.
So you've done business valuation, right?
I think we didn't get to that place, so.
You didn't do business valuation, whereby you calculate for maybe ratios, return on equity.
Yeah, we did it.
Okay. So that is the same. You have the industry ratio and those things. So you do that to help you to know which company or which firm is performing than the other. Those are some of the reasons for doing those. So when it comes to expected return, expected means that maybe you have two companies to invest in. Okay, company A and company B, and you have their outcomes and probabilities. So you have to calculate for the expected return for each company to know which company has the higher expected return to help you in evaluating your investment decision. All right, so you've already been given the formula. Expected return is the summation of the product of the, the way I'm saying it will confuse you. So the summation is the sigma sign, and the P is the probabilities. So the probability times the outcome. So each probability times its outcome. Each probability times its outcome. And the sigma will be the summation of the product of the probability and the outcomes. As simple as that. So here, if you want to find the expected return, is the 450 times 0.2, because the 450, the probability is 0.2. 650, probability is 0.6. And 852, the probability is 0.2. So you do the multiplication, then you sum them. So 450 times 0.2 plus 650 times 0.6, 850 times 0.2 is going to give us 650 million. So that is the expected return for this example. Please, I hope you understand how we derive the 650. I want you to understand this one so that as you are moving on and we are adding on.
Yes, sir.
All right. Then let's move on. So now we have example 2. Calculate the expected return of the following investment. So based on market condition, recession, normal, and boom. So the probability for recession is 1/3. The return on investment is -8. And return on investment B. So we have two investments. two investment A and investment B. And the question is to calculate the expected return of the following investments. You have investment A and investment B. So if you want to calculate the return for investment A, is what? The 1/3 times the -8 into brackets plus 1/3 times 5 plus 1/3 times 18. The summation of this will give you the expected return for investment A. When you finish, you come and do the computation for investment B2. Hello? Afiba, were you speaking off? I heard your voice. All right, let's move on. So when you finish, then you come and do your computation for investment B as well. So investment B2 is going to be 1/3 times 20 plus 1/3 times 3 plus 1/3 times -20. So, board mass, you deal with your bracket first. So when you finish, you add them all. So that is going to give you the expected return for investment A and also the expected return for investment B. So let's see how you've done it. So this is investment A, exactly as I was saying. Good. So this is how you've even done it here. Because they were all having the same probability of 1/3, they just brought the 1/3 and open a bracket for the summation of the outcomes. Because they were all having the same probability, 1/3, 1/3. But if for you not to be confused, you can just do it separately. 1/3 times -8 plus 1/3 times 5 plus 1/3 times 18. All right. So investment A is having an expected return of 5%, and investment B is also having an expected return of 1%. As a rational investor, which of these investments will you invest your money, or will you invest into it? And why? Anybody?
Hello, sir.
Yes, sir. Andres.
Yes. I am thinking that the issue we are looking at is expected return.
Sure.
And expected return means that what I will get at the end of the
Investment.
investment period.
Sure.
So if one is giving me 5% and the other is giving me 1%, I'll go for the one that is giving me 5%.
Good, because it's higher, right?
Yes, it's higher.
Good. So you are trying to say that if your decision, your choice is to be made based on expected returns, you are going to choose investment A because it has a higher return than investment B. And that is period. All right, thank you.
Great.
All right. So you have another one here. Return on investment A, return on investment B. And we have the probabilities here 0.4, 0.3, 0.3. And we have to calculate the expected return of project A and B. So I know the solution is there, but I know you understand the solution. Please, if you don't understand, let us know. It's the same as the previous. So 0.4 times 20 plus 0.3 times 15 plus 0.3 times 10. You do for investment A, return A. When you finish, you come and do for return B. Then based on the requirement of the question, if they are to ask which investment will you go in for, then you go in for the one with the highest return, as Andrews just explained. So with this example, you are going for investment A because it has a higher return, which is 15.5, and investment B is also having a return of 12.6. Good. Sometimes we don't always make decisions based on returns. Sometimes you have to consider the risk component as well. So some will go for the one with the highest return, or others will go in for the one with the lowest risk. So if you are choosing based on return, you're going for the higher return. But if you are choosing based on risk, you're going for the one with the lower risk. Because nobody wants higher risk. Going for the one with the lower risk. Risk here means deviation. Okay, risk here means that we are looking at deviation. I know you've also done standard deviation in your quantitative method and those things, so we know what risk is about. So the probability that what you expect may not come true is a risk or deviation. In finance, risk or variability in expected return is measured by three statistics. In finance, when we are looking at risk, or investment management, when we are looking at risk, we are using three statistics to measure risk. We have one, variance of return. You know variance, how to calculate variance. Two is standard deviation. And three, coefficient of variation. So we are going, maybe in a question, they will just let them calculate the variance too, calculate the standard deviation, calculate the coefficient of variation. Or maybe the question will just ask you to calculate the standard deviation. And you know, for you to get standard deviation, first of all, you need to calculate for your variance first. Then you square your variance to get standard deviation. So variance. The general formula for calculating for variance is square of standard deviation. Is that so? I hope you know this sign is standard deviation, right? This sign, can you see it?
Yes, sir.
Good. So if you square it, it means you are getting the variance. And how do we calculate for the variance here? So the variance is the return. So the probability is outside. The probability is multiplying into bracket the return minus the expected return. So the return is the one given to you in the question, and the expected return is the one you calculated for. The one that Andrew told us that if he's to choose, he will choose 5% over 1%. Those are the expected return. It means that in a question, if you are to calculate for the standard deviation, you have to first of all calculate for your expected return before you can proceed with the standard deviation. And do you know what it means? It means if you get the expected return wrong, you are going to get the standard deviation too wrong because you are going to use a figure to translate here. So you always have to be careful. You know, it's not difficult. Every figure will be given to you. You just have to know where to put it and you are good to go. So the return is the summation. P is out. P is the probability into brackets R minus ER. R means return and ER means the expected return. All square. So we square the one in the brackets. The formula is very important to me, so check. P is out of the brackets and the bracket is in front of the P. So in the bracket, we have R minus CR. And the bracket will close square. Like the way we've done here. Like the one I've highlighted here. A standard deviation that has been squared. Okay. So if you square the standard deviation, you are going to get the variance. That is the variance. But if the question also asks for the standard deviation, you just put the variance in a square root, then you get your standard deviation. This one, you've done it in quantitative, you've done it in statistics, you know, so you may be familiar with it. True or false?
So true.
Good, thank you. Okay, so yeah, so the standard deviation I've already explained. A square root of the variance, you get a standard deviation. And the coefficient of variation is the standard deviation divided by the expected return. So SD over expected return will give you the coefficient of variation. So if you look at the thing, you know, expected return, variance, standard deviation, coefficient of variation, you cannot do one without the other. It means that the question can just ask you just one requirement, calculate for the coefficient of variation. It means that for you to calculate the coefficient of variation, you will need standard deviation over expected return. For you to calculate standard deviation, you have to calculate for variance. And expected return too has to be calculated. That's the first thing you have to calculate for before you calculate for your variance, before your standard deviation, before your coefficient of variation. It's not difficult at all. It's not. You just have to follow, get a formula. Once you get a formula, you are good to go. And the formula too is not difficult. Okay, the variation is just the probability into bracket, return minus expected return, all squared. That is all. Good. So we are using the same example. See, I don't want to stress you people, so I'm giving you the same example so that you can understand. So this question, we solved it already, but calculate the expected return. 2, variance. 3, standard deviation. And 4, coefficient of variation of each of the following investments. And the question is that as a rational investor, which investment will you prefer? As a rational investor, which investment will you prefer? So we have to calculate our expected return, our variance, standard deviation, and coefficient of variation. Then as a rational investor, which investments are you going in for? So first of all, how do you calculate your expected return? You've done it, but I just want to be sure if you are following me. Anybody to help? 50 naughty. The first time I'm mentioning Gifty's name. Gifty, are you there?
I am here.
Good, good, good. Do you want to help us with it? Expected return. Only the expected return. Can you help us? 50. Okay, anybody else to help? Expected return. Apart from Andrews. Was Andrews, you are the one who explained the other one? No, it wasn't Andrews. Somebody explained something, I've forgotten. I think Afiba. Yeah. Okay, Andrews, then you can help.
Okay, sir. So the expected return, when we're doing it here, because the probability has the same denominator, we put the investments together and then we find the expected return,
Sure.
which is 1/3 multiplied by -8 plus 5 plus 18.
Sure.
Then we come to investment B, also 1/3 multiplied by plus 20 plus 3 plus -20. And then we were able to get that one too.
Expected return. Sure. Sure. So up to this point, I know you understand. So let's go to how to find the variance. So this is the expected return, exactly as Andrews was explaining, because the probability, they have the same weight. That's why we put it outside and we just added everything. Good. Now the question is asking us to find the variance, and this is the variance formula. Okay. So variance formula equals P into brackets return minus expected return, and we square the bracket. And here, our return was already given in the question. The returns are the returns are these ones, the 8, the 5, and the 18. They are already given in the question. Always they are given. That one I can say. The return is always given. But you have to calculate for the expected return. We've already calculated for the expected return. So it means that if you want to find the variance for investment A, it's going to be the probability, which is 1/3 into brackets R, which is okay. So the R, it means I have to do at each level. Here the R will be -8 minus the expected return, which is 5% all square, plus another probability 1/3 into bracket 5. I hope you get it. Then we do it same. Then we get the expected return. So let me show you here. This is how the variance is calculated. You see, we are doing it this way because the probability is the same at all levels. But if it's not the same, it means that at every point here, you should bring the probability here. You should also bring the probability here as well at every point. But here, because the probabilities are the same, that is why we open one big bracket, 1/3 into bracket, -8 minus 5. So the -8 is the return, minus 5. 5 is the expected return, all square, plus 5 minus 5 all square, plus 80 minus 5 all square. And we are getting 112.7. This is the variance for investment A. And investment B, same procedure. We are getting 267.7 for investment B. Once you get your variance, the rest are not difficult. You know how to calculate standard deviation. You just find the square root of the variance. You just put the variance figure in the square root on your calculator. Whatever you get is the standard deviation. Then your coefficient of variation will be your standard deviation over expected return. So your focus should be on how to calculate the expected return and the variance. Okay. And now you know how to calculate the variance based on the formula that is given here. The summation of the probability and the return minus the expected return all squared. Okay. So 1/3 minus 8, blah, 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 then we are good to go. Yes, so the standard deviation, as I said, you just find the square root.
Doctor, sir.
Yes, sir.
So, the previous slide, before we
Yeah.
come to the standard deviation, I want to ask a question on the previous slide.
All right.
Yes. So, said the expected return for investment A was 5%.
Sure.
And then that of investment B was also 1%.
Yeah.
So in putting it in the equation, we only use the 5, but it was in percentage. Do we ignore the percentage and then go straight to use the 5?
Okay, you mean because it was in percent? You see, we ignore the percentage because the return to was in percentage, because the outcome in the question was also in percentage, right?
Yes.
Yes. See this one?
Yeah.
They are all in percentage. But because they all have the same unit, that is why we ignored it.
Okay.
Yeah. So when you are calculating for the variance, just ignore the percentage. Use the figure.
Okay.
So, all right. So standard deviation. So you see at the end of the figure, after the standard deviation, we brought the percentage approach. So standard deviation to find the square root of the variance. Whatever you get is the standard deviation. So when you get the standard deviation, then you bring the percentage sign to it. That's it. So if you bring it blank, it might confuse you in your computation. Then the coefficient of variation, which is the standard deviation over expected return. So you have two investment A and B. So you see, whatever you are doing for investment A, you are doing same for investment B. So don't forget, don't just go and do one side, then you think you are done with the question. No. The question came with two investment portfolio, investment A and investment B. So you have the expected return here to be 5 and 1. You have the standard deviation to be 10 and 16. So as a rational investor, I know I've already asked that, but I'm just asking again. Which investment decision are you going to? Which one are you going to invest in? And
So
why?
A,
Okay.
based on the coefficient of the variation,
Hmm.
the one the higher number is that it takes the highest risk.
Good. The higher number takes the
Highest risk.
okay.
So when you are investing, you have to look for the lower the risk, the one that is lower for the risk.
So you mean if you are
You
deciding the coefficient of variation, you go in for the one with the lowest coefficient of variation. Is that it? Or
yeah, that one, yeah, that's what I'm saying.
okay. All right. So from this, we are going for investment A. So it's still investment A. Even if we are looking at the standard deviation is risk. So investment A is having 10.6% and investment B is having 16.4. Means that investment B is more riskier than investment A. So you're going for investment A. And even still, when you look at the return, investment A still have the higher return. So if your decision is based on coefficient of variation, you choose the one with the lowest coefficient of variation, as she just explained. All right. Please, up to this point, is it difficult? I don't think it's difficult. You just need to get your formula in practice. Because I think the understanding is there, so you just need to practice the same question. Like if you have solution in the slide, have a full question in the slide, you can make good use of it. Let's continue. Any question up to this point? Okay. Okay, so portfolio return. So portfolio return means that an investment or an investor may have more than one investment product. So there will be a portfolio. Portfolio means that the portfolio is made up of more than one investment. Okay. So the combination of two or more investment is what we refer to as portfolio investment. So here we calculated for the risk and the return for individual or for each investment. So we calculated for investment A, we calculated for investment B. But there can be a situation whereby investment A and B are all in one portfolio. So when such situation occur, it means that we have to find the expected risks, the return, the variance, and all those things for the portfolio as well. So portfolio means that if you put them together, what is the return? What is the variance? What is the standard deviation? Right. So the expected return on a portfolio of two or more. So a portfolio can be made up of two or more investments. But when the portfolio is more than two, computation becomes very difficult. So in an exams, it will be limited to just two investments in a portfolio so that you can save your book. So there's a lot of computation that will be involved. But for your knowledge sake, you can also learn how to calculate the risk, expected return when we have more than two investments in a portfolio. The ones we have done is just individual ones, okay? All right, so let's move on. So suppose two investments A and B have expected returns. Two investments A and B have expected return of 10% and 20% respectively. So investment A is having expected return of 10. Investment B is also having expected return of 20. You decided to invest 45% of your resources in investment A and the remaining 55 in investment B. So the question is that what is the expected return of this portfolio? So the expected return. How do you calculate for the expected return for individual investments? When you were doing the previous, what was the formula? Can anybody remember?
Summation of probability and rate. So it was the P times R.
Good. So the probability times the return. The probability times the return, right?
Yes, sir.
That is how we calculate for the expected return. So when it comes to the portfolio too, so with this portfolio, they've already given us the expected return to be 10% and 20%. So if you want to find the probability, the what am I saying? The return of the portfolio. So is the proportion of investment in proportion of investment A in a portfolio times the expected return of investment A plus the proportion of investment B in a portfolio times the return. So for you to even find the expected return of the portfolio, you still have to calculate the expected return of the individual investment as you have done in the previous. So when you finish, then you just multiply the two and add them together. Because you know this question they give us straightforward the expected return in investment A and B. We didn't calculate for it here. You can see they give us expected return from investment A and B. We didn't calculate, they just give it to us. So if you want to find the expected return of the portfolio, is the 45 here. So the 45 here is the proportion of investment A. Because we said we invested 45% of our financial resource in investment A and the remaining 55 in investment B. It means that in the portfolio is made up of 100% investment. The 45% is the portion of investment A in the portfolio, and 55% is the proportion of investment B in the portfolio. So if you want to find the expected return, is the expected return times its proportion plus expected return times its proportion. Then we get the expected return of the whole portfolio. I hope it's not difficult. Okay, so let's see. Good. So this is the formula. So see from the formula, XA is the proportion of investment A in the portfolio. So proportion of investment A times expected return of A. Have you seen it? Plus proportion of investment B times expected return of B plus dot, dot, dot. It means that this one they are just trying to, in case you have more than two investments in a portfolio, it means that the formula will not end here. It will not end, but it will continue here. But as I'm saying, you'll be limited to only two investments. So it means that your formula will be limited to this side. All right, so expected return of a portfolio is proportion of investment A times expected return of A plus proportion of investment B times expected return of B. You see how important the expected return is. If you get this wrong, that is the first thing you are going to calculate for. Which means that if you get the expected return wrong, any other thing that follows will be wrong. And that will be very catastrophic. Because it's going to lead you, it will follow you from top to down.
So help us not to get it wrong.
I've helped you. Now you have to sit down and practice so that you don't get it wrong. Yes. Two of us. I've done it. Yeah, you just have to sit and practice. Okay, I didn't. Let me see. Okay, Andrew, you were the one speaking, or?
Yes, sir. Yes, sir.
How do you calculate for expected return? Don't look anywhere. Just tell me straightforward.
So you take the summation of the probability and then the rate of return multiply by the rate.
Did you say summation?
Yeah.
So okay, so you just mention the formula. Don't explain the formula, man.
Summation of P and R.
Okay, P and R.
Yes.
To give you the expected return. So if probability of investment A is maybe 20, 10, and 40, it means that 20 times the return plus 40 times the return plus 40 times the return, something like that, right?
Yes, sir.
Okay. Okay. So the expected return computation is not difficult. In some slightly tricky question, the question may not give you the probability percentages, but they can tell you that they have the equal chance of occurring. What does it mean? Maybe we have three: recession, boom, and normal. And they're telling that they have the equal chance of occurring, or it's probable that all the investments will occur. It means that they all have the same probability of occurring, right?
Yes, sir.
So it means that if they are three, you have to make it 1/3.
Yeah.
If they are four, you have to make it 1/4. It means that each one has a probability of 1/4, or they have equal chance of occurring. I've given you a serious breakthrough because in case you meet it anywhere one day, sometimes it's good to join class. The book may not always be there for you to read. Certain things, when you hear it, Okay, that's just by the way. Let's continue.
The prophecy is coming small.
Once more. Good. All right, so now let's go to the risk. Okay, so the risk is measures the variability of the investment portfolio. Let me start from here. When calculating for portfolio variance, we need to calculate the individual variances, the covariance and correlation coefficients before we can do same for the portfolio. So this one too, they can give you one question. They tell you to calculate the standard deviation of the portfolio. It's one question, but it involves you have to first of all calculate for all the individual ones, individual variance, standard deviation, expected return. You come and calculate for the expected return of the portfolio. Then, before you can go ahead and calculate the standard deviation of the portfolio. Each of them advantage is that they all have formulas. So you just have to know the formula. Once you get the formula, the constituent of the formula will be known already. All right, so covariance. So it measures the variability of the returns on investment in a portfolio. In other words, the covariance measures the extent to which the uncertainties of the returns on the two assets tend to reinforce or offset each other. So we assume that when we have two investments in a portfolio, so we have two investment A and B. This is how we calculate for the covariance. When you have two investments in a portfolio, this is how we calculate for the covariance. So the covariance is the probability to bracket return minus expected return of A. Because this one is no more variance, it's covariance means we have more than one investment in the portfolio. I hope you understand. In the previous one, it was variance, if you remember. Then in calculating the standard deviation, we just put the square root of the variance. But here, you have more than one investment, so they become co-equal. Are you my co-equal? So covariance, you have more than one. So the return minus expected return. You see, in the previous one, in the variance, there was a square at the end of each, remember? But in the covariance, there is no square. Have you seen it?
Yes, sir.
Good.
Yes.
So just study the formulas. When you finish, just go through under each formula, make sure you can solve a question. In fact, make sure you can solve all the question in this slide. Then I'm not sure your quiz and the rest will be difficult for you. Right. So we have been given, so this is the formula: return minus expected return of A, return minus expected return of B. So it means that the covariance of the portfolio is made up of expected return of A and expected return. Have you seen? We are multiplying the two variance together, or multiplying by the probability to get the covariance of A and B. Okay, so example one, you have been given information on two investments, A and B, as shown below. Calculate the covariance of the two securities. So this is it. We have been given this question. We've solved it. Calculate the covariance of A and B. So for you to calculate the covariance, first of all, you need to calculate your expected return. As for that one, don't forget, calculate your expected return first. You know how to calculate for expected return. When you finish, then you just follow the formula to calculate for your covariance. You see this one, because they have the same probabilities. That is why we are doing it as that. So the formula is this. So at each level, return minus expected return of A, return minus expected return of B, all multiplied by the probability. So when we start from here, the probability is 1/3. The return was -8 minus expected return was 5 times return of B was 20 and the expected return was 1. Bracket close. Plus, we come to the next one, recession. You know we have 3 with market condition, recession. So you do for recession, you do for normal, you do for boom. Then we add all of them together. So that's what we are doing. So this is recession. This is recession. Sorry, it's not reception, it's recession. And this is normal, and this is boom. We add all the 3, then we get a covariance of -173.3. That is what we are getting, so we have to report. So 1/3 -8 minus 5 times 20 minus 1. Come to the other one, 5 minus 5 into bracket 3 minus 1 plus 1/3, blah, blah, blah. You follow in that direction. The probabilities may not always be the same. So that one, they don't let it confuse you. The probabilities are already given in the question. So you use what is given in the question to calculate for the covariance. So the covariance of two investments, A and B, can also be written as. So the covariance for two investments can also be written as this. Where PAB. So covariance for two investments can be written as this. Where the PAB is the correlation coefficient. Correlation coefficient, and A and B are the standard deviation of A and B respectively. It means that we can also calculate for your covariance in a different way when the correlation coefficient is given to you in the question. That is what they are telling you. The correlation coefficient, the covariance of the two can be written as this. The correlation coefficient times the product of the two standard deviation will give you the covariance. And in another way, if we also know how to calculate the covariance using this formula. So it means that in a question or in a situation where the correlation coefficient, which is the PAB, in a situation where the correlation coefficient is given, you can use this formula to find your covariance. Simple as that. So note, let me highlight the note. Note that this can only be used when the correlation coefficient and the variance of the two securities are known. Can only be used when the two are known. All right. So we are getting there. So when you have so this is the correlation coefficient. This is the formula. Correlation coefficient equals covariance of A and B over product of the standard deviation of A and B. So you just do, we are making covariance the subject. So when you make covariance the subject means that we are going to multiply PAB by this. So in the previous, that is how they've gotten this. I hope you understand now. So this is how to derive the covariance of A and B. So the covariance of A and B equals the correlation coefficient times standard deviation of A times standard deviation of B. Simple as that. That is how to get the covariance of A and B. All right. Good. So after you find the covariance, then you can now find the variance. So the general formula for calculating the variance, this is the general formula for. As for the standard, the variance is this. Yeah, this is the variance. It's the one that we know. This is for the one investment. But if you have more than one investment, this is how to calculate the variance of the portfolio. So whatever we are doing is a built on or is an add-on. It means that if you want to find the variance, you need the covariance. And we've already gone through how to calculate the covariance. We did two approaches, where the correlation coefficient is given and where the correlation coefficient is not given. If it's not given, you go through by the one we did. When it's given, you multiply the correlation coefficient by the product of the two standard deviation of investment A and B. That is how you arrive at the covariance of A and B. You know XA and XB. These are the proportion of investment. The proportion of investment in investment A and investment B. This is 2. You know 2. Or I should explain 2. Do you know 2? 2 means we have 2 investments in a portfolio, right? So it's 2. 2 is constant. Then we have, this is standard deviation. No, because the bracket is outside, because the square is outside, it means that it's the standard deviation of B times the proportion of investment in B all square. In fact, why am I reading from the left to the right? Let me start from right to the left. Let me start from here. So the variance of the portfolio is standard deviation of A times proportion of investment in A square plus standard deviation of B plus proportion of investment in B. So you can see that we have standard deviation of A, proportion of investment in A square. Then we come again, standard deviation of B, proportion of investment in B all square, plus 2, to bracket, proportion of investment in A and proportion of investment in B. They are multiplying times the covariance of A and B. So this is the formula to get the correlation, the variance of the portfolio. Once you get the variance, you know how to get standard deviation. You just put the variance in a square root, then you can arrive at your standard deviation. Any question? And all these elements, you know how to calculate for standard deviation of A. You know how to calculate for standard deviation of B. Proportion of investment in A will be given. Proportion of investment in B will be given. Covariance of A and B, you know how to calculate for it. If it's not given, and most of the time they will not give it to you. It's either they'll give you the correlation coefficient. If they give you the correlation coefficient, then you are lucky. You just multiply the correlation coefficient with the standard deviation of A and the standard deviation of B. If it's not given, you know how to find it. You come and use this formula to find the covariance of, is it this formula? Yeah. Use this to find the covariance of A and B. Okay. Good. So, so when we have 3 investments in a portfolio, this is how the formula is going to be, as long as you can see. Let me expand it so that you see the formula. Now you understand why I said 3 investment portfolio will not be commendable. This is the formula. When you have 3 investments in a portfolio, so it's going to be standard variance of A times. The yellow is too bright and I can't see myself.
Sir,
Yes, dear.
what we are doing, is it not quantitative methods?
Yes, it's quantitative because we are doing standard deviation.
Sir, this course, we were running away from it too.
Please don't worry, it will not come back to you. We are not doing 3 investment portfolio, okay? It's only 2, but I'm just, I told you from the onset that it will be limited to 2, but I'm just exposing you to the 3. Okay, but I hope up to the 2 you understand, right?
Somehow, but when you finish, I'll sit and then go by everything
Because,
again.
it's a formula. You may not get it on set, but when you sit down and you practice, it will stick. Yeah, it will stick easily. The formula is not difficult because when you look at this, here is everything A, standard deviation and proportion of A, standard deviation and proportion of B, and plus 2, proportion of A and B, and the covariance of A and B. All right, so let's take this example 2 here. You have been provided with the following information for investment A and B. So obviously it's 2. So this is it. The same question. I think we've used this question before. Have boom, normal and recession probabilities. You have boom 40, 30, 30. And the return of investment is 20, 15, 10. 9, 12, 18. Okay. So I want you to practice on this. It's not an assignment. Please, I've not said it anywhere. Just try your hand on this. The solution is in the book. But get all your formulas and try your hand. I know up for the individual investment, I know you can do, but start from the top. Expected return of A and B, variance of A and B, standard deviation of A and B, coefficient of variation A and B. Then you come and do the expected return of the portfolio to A and B, variance, covariance of A and B. Come and do the variance, then you do the standard deviation as well. Practice them so that you get the formulas at your fingertips. So try your hand on the slide 43. It's for your own good. Thank you. All right. So I think we will end here because of the time. My time is up. So risk and diversification, we will continue in our next meeting. I will do it before I move to the next one I'm supposed to. It's just reading, there's no calculation. But I'll touch on it before we move to our next debate. This is the solution to the one I said you should try your hand on. Please try to try it. Okay, it says I'm
Sir,
try your hands on it.
The exams, this
Right.
one. Exactly this one.
Please. Say try your hand on it. I didn't say anything. I'm not a prophet too, I beg. Don't prophesy, it's too early to prophesy. So just try your hand. Whatever happens, at least it will be for your advantage. Okay,
Yes,
so
Sir,
any questions so far?
Sir, I hope you are sending the slides to us.
Oh yeah, because I was having the previous chapter, we didn't finish. That is why I didn't send you the slide.
Okay.
Yeah. Because I didn't finish the chapter 2, that is why I didn't send you the slide.
Okay.
All right. So I will send you the slide. Try your hand on this. And if you have time, you can walk through the remaining. But just try up to from beginning to wherever we go to. Make sure you understand everything. Maybe it will help you one day. Maybe. All right. So any question?
Atamuda.
Any question?
No questions. Hey.
Okay. All right. Then enjoy your evening.
Thank you, sir.
Thank you, sir.
All right.
Thank you
We
very
really
much.
appreciate it.
Thank you too. You're welcome.
The way you are appreciating the exams day. So you people are appreciating the exams day, no?
Oh no, we are appreciating because of the time that
You are fever.
Bye bye.